Thanks for linking on to 2 minutes or less. Today we're going to skim through the qualification guidelines for the self-employed. There's no question that self-employment has its benefits. For example, the preferential tax treatment, the flexible lifestyle, and customized work schedules, and of course, the pride in ownership of your very own business. Mortgage qualification also had its limelight in the self-employed arena, but definitely not lately. Since 2008, the rules got tougher and tougher. So tough, in fact, that the current rules and policy changes have forced business owners to reconsider withholding retained earnings in the business accounts in favor of declaring a larger amount in an effort to qualify for a mortgage. From about 1999 to 2008, business owners have had the luxury of declaring a very low income to win the tax game and simultaneously declare a much higher, unverified income for mortgage purposes. At the moment, business owners will not have the best of both worlds. Declaring a low income to avoid higher taxation remains and will forever be an attractive feature of self-employment, but from a financing perspective, it's a new order. This is where the new order starts and finishes. It's called the reasonability factor. For starters, self-employed individuals are never asked for pay stubs or letters of employment. Instead, they're expected to submit the most raw form of income verification available, taxation documents. The last 2 years of T1 generals and notice of assessments are most commonly requested from lenders, and in some instances, the business financials. The T1 general is the first sequential tax document. It is in this document where the lender clearly sees the breakdown and classification of a self-employed individual's income. In some cases, self-employed applicants will declare several sources of income from various companies, investments, and even other forms of employment. The T1 general is then sent to Canada Revenue Agency, where it's reviewed and then a notice of assessment is generated. In it, the following is summarized: the taxpayer name, the taxpayer insurance number, tax year, and tax center. It also provides a summary of income deductions, credits, and taxes previously paid or balances owing. There's two main things that the lenders look for in a notice of assessment. That being line 150, which is the amount of income declared and whether or not there is a balance owing. The easy route is when you can simply do a 2-year average of line 150, where some lenders even let you gross it up by an additional 15%. The other way, and this is where the new order of financing for self-employed comes in, is when the applicant declares a very low income, so low that if that was the income that the lender would use, they would probably qualify for a shockingly lower mortgage amount than they expected. So in these instances, as long as you have a sub-average credit score, and with some lenders, a superior credit score is required, you earn the privilege of self-declaring an income to qualify for the mortgage. For example, if you're a self-employed hairstylist declaring $12,000 but need to state $80,000 to qualify for your mortgage, the lender might deem that as unreasonable. And this is where the battles begin. What is a reasonable income in your profession? In all cases, you'll never know until you submit an application for approval, as there are no pre-approvals for self-employed applications. Thanks for tuning into this edition of 2 Minutes or Less with Home Financing Solutions, the Mortgage Center. If you have any further questions, please contact the mortgage associate who sent you this link or call the number on the screen. Home Financing Solutions, the Mortgage Center is an award-winning brokerage with offices in Calgary and Vancouver.